Making investment decisions. Shareholders of a firm would like managers to invest in positive NPV projects to increase the firm value. Thus, managers can support the cause of owners by selecting positive NPV projects and rejecting negative NPV projects. We start the discussion by reviewing our good old NPV rule. Then we turn to some other often employed decision rules of making investment. These first two rules are payback period and book rate of return. These methods, though simple but are empirically less rigorous and act as the rule of thumb that is easy to compute and communicate. However, multi-million dollar businesses need more than just a thumb rule for making large capital investment decisions. Another very important measure that we discuss here is internal rate of return measure. This measure is often compared with the expected rate of return by shareholders for investing in similar risk projects. In this discussion, we'll also observe that various times these measures contradict each other. Many times capital is a scarce resource and even good positive NPV projects need to be rejected in favor of other better projects. In this lesson, we'll also discuss ways to resolve such contradictions. Review of NPV Basics. In this video, we'll review our learnings of NPV criteria as a decision rule for the selection and rejection of projects. Consider yourself in a position of a CFO where you are analyzing $1 million investment in a new venture called Project P. You project the cash flow generated by the project over its useful life. You also estimate its appropriate opportunity cost of capital R. You find the NPV of this project by discounting the cash flows, adding them up to compute their present value PV, and subtracting the initial investment of $1 million. It is given to you that the current market value of your firm is $10 million, which includes $1 million cash that you plan to invest in Project P. The other assets and opportunities with the firm must be valued by market at $9 million. Therefore, should you decide to accept this project, the value of your firm will be 10 minus 1 plus PV, that is equal to 9 plus PV. It is easy to understand if this present value PV is greater than 9, this project has a positive NPV. Also, instead of investing in this project, you can distribute the cash to shareholders who can themselves invest in capital markets on their own. So essentially, the opportunity cost is investing in the project rather than investing in the capital markets. Thus, the project opportunity cost is precisely the rate of return that shareholders can obtain by investing in financial market instruments. This is summarized in the diagram shown here. But what kind of financial market instruments to choose for the selection of opportunity costs? Ideally, assets of equivalent risk as your project should be chosen to estimate the opportunity cost or expected returns on your project. The following are key aspects of NPV rule. First, NPV rule recognizes that a dollar today is worth more than a dollar tomorrow. This is so because dollar today can be put to use by investing it and start earning interest on it. NPV heavily relies upon the forecasted cash flows of the project and its opportunity cost of capital. Present values are measured in today's dollar terms, so they can be added. Lastly, any decision rule that is affected by manager's taste, choice of accounting period, the profitability of existing business, or that of other projects will lead to an inefficient decision rule. Therefore, net present value of A plus B is equal to NPV of A plus NPV of B. In this expression, if project B has negative NPV, then NPV of A plus B, though positive, is lower than NPV of A. Therefore, NPV will identify that and you would not take project B just because it is packaged with a good project A. Those decision rules that do not have this property or capacity are considered inferior. Companies report their incomes frequently. These book incomes are not necessarily the same as cash flows. Take for example the case of depreciation expenses. Even though it is a non-cash expense, it is subtracted from book income to arrive at profits. Therefore, profitability measures such as book rate of returns heavily depend on the classification of various items as capital investment and their rate of depreciation. However, it should be very clear by now that a project selection or rejection should not depend on how accountants classify cash flows or expenses. Thus, measures such as book rate of return are not considered as robust. To summarize, in this video, we discussed that NPV rule is a simple but a very powerful rule for the following reasons. First, it considers the time value of money. Second, it reflects the fact that a dollar today is worth more than a dollar tomorrow. Present values can be simply added up in today's dollar terms. However, the efficiency of NPV rule depends on the ability of managers to project cash flows in future and estimate the appropriate opportunity cost of capital, that is discount rate. Alternatives to NPV rule. Payback period method. In this video, we'll discuss the pros and cons of the payback period method. A project's payback period is simply found by estimating the years it takes for the project cash flows to meet the initial investment. For example, a washing machine is costing $100. You spend $300 a year on washing your clothes. As a thumb rule, if this machine is purchased, it will recover its expenses in 3 years. The payback rule states that a project should be accepted if its payback period is less than some cutoff period. For example, in the previous case, if the cutoff period is 4 years, then the washing machine will be purchased. Consider a simple example shown here. Cash flows corresponding to projects A, B, and C are provided along with their payback period and net present values at 10% discount rate. The NPV, that is net present value rule, suggests accepting projects A and C but rejects project B. Contrasting results are obtained as per the payback rule. If a 2-year cutoff period is selected, then as per the payback rule, only projects B and C would be selected. Thus, payback rule offers misleading results for the following reasons. It ignores the cash flows after the cutoff period. It does not consider the time value of money and therefore gives equal weight to all the cash flows before cutoff date. Therefore, if you entirely rely on payback rule, you will miss good projects with long life and may accept poor projects that are short-lived. However, managers often use this rule to select projects due to quick profits and early investment recovery. Remember our discussion of separation of ownership and control and its implication for managers' incentives being not aligned with those of shareholders. An improved version of payback period is to employ discounted cash flows. Let us examine our previous example with the help of discounted cash flows. This discounted payback rule examines that how many years it takes for the discounted cash flows to recover the initial investment, that is, net present value becomes positive. Unlike simple payback rule, this rule would not accept negative NPV projects. Still, it does not take account of good long-term projects such as A. Thus, this method can be considered as a warning signal to put a red flag where projects are showing very optimistic forecast in distant future. To summarize, in this video, we learned that discounted payback period method is a simple thumb rule to examine how many years it takes to recover the initial investment. However, this rule does not consider time value of money. Also, it ignores cash flows that are after some pre-specified cutoff date. An improved version of the payback period method is discounted payback method, wherein discounted cash flows are considered for project evaluation. However, these discounted cash flows also give zero weight to cash flows after the cutoff date. Thus, while these payback rules may act as a simple thumb rules, they are still much inferior to the NPV criteria. Alternatives to NPV rule: internal rate of return, that is IRR method. In this video, we'll discuss the IRR rule, we'll understand the computation of IRR and its application in project evaluation. Internal rate of return, that is IRR, is one of the often used measures as a project evaluation criteria. The ancestry of IRR rule comes from the simple return measure shown here. For a one-period project, the return can be simply computed as shown here. Project return equal to profit upon investment equal to payoff upon investment minus 1. If we carefully examine this formula, we can rearrange it slightly to obtain the expression as shown here. Minus investment plus payoff upon 1 plus project return equal to 0. It should not be very difficult to see here that the NPV of the project is 0 at this return. This can be generalized to a multi-period project to define a more generic IRR formula. That is, IRR is the return or discount rate at which NPV equal to 0. It is a very useful measure, though it sometimes contradicts inferences from NPV rule. With this definition, the IRR rule can be expressed as shown here. Net present value NPV equal to C0 plus C1 upon 1 plus IRR plus C2 upon 1 plus IRR raised to the power 2 and so on up to CT upon 1 plus IRR raised to the power T equal to 0. A number of softwares including Microsoft Excel are available to solve this expression. Consider the cash flows from a project as provided here. The IRR computation for these cash flows can be simply shown as net present value NPV equal to minus 4000 plus 2000 upon 1 plus IRR plus 4000 upon 1 plus IRR raised to the power 2 equal to 0. Solving for this, we get IRR equal to 28.08%. Let us examine this in more detail. What happens to NPV as discount rate changes? Although we already know that NPV becomes 0 at IRR equal to 28.08%, this is shown here in the diagram as well. In the diagram, we can easily see that if opportunity cost of capital is less than the 28.08% IRR, then the project has a positive NPV. Of course, if the opportunity cost is same as IRR, then NPV equal to 0. If opportunity cost of capital is greater than the IRR, the project has a negative NPV. Hence, we compare the opportunity cost of capital with the IRR on our project. Thus, this rule holds whenever NPV of a project is a continuously declining function of discount rate. This may not always be true. Often, we tend to confuse opportunity cost with IRR. Please note that IRR is a profitability measure and depends solely on the timing of the project cash flows. In contrast, the opportunity cost of capital is the standard of profitability to judge the worth or NPV of the project. So, at the opportunity cost of capital, a project's NPV can be positive, negative, or zero. However, if project cash flows are discounted at IRR, NPV is necessarily equal to zero. Also, the opportunity cost is observed and estimated from capital markets by examining the securities with similar risk as that of the project. To summarize, in this video, we discussed the IRR measure of project profitability. IRR measure is the discount rate at which NPV equal to 0. IRR is intrinsic to the project, and unlike opportunity cost of capital that was determined from well-functioning capital markets, IRR is dependent on project cash flows only. The simple decision rule here is to accept an investment project if the opportunity cost of capital is less than IRR, or reject the project if the opportunity cost of capital is more than IRR. Pitfalls of IRR. In this video, we'll discuss various pitfalls associated with IRR as compared to the NPV rule. We'll also see why, despite these pitfalls, IRR is still an important profitability measure. Lastly, we'll also discuss how to improve IRR in some of these pitfall situations. IRR rule is also not free from pitfalls. Remember the caveats highlighted earlier during the IRR discussion. Let us examine these pitfalls one by one. Pitfall 1. Problem of lending versus borrowing. Consider the project cash flows from projects A and B as shown here. Both of these projects will give you the same IRR, but have a look at their NPVs. The NPV suggests that these projects obviously cannot be equally attractive. In the project A, we are paying out $1,000 initially and getting $1,500 later, a case of lending or investing, while in the case of B, we are initially getting $1,000 and paying back $1,500 later, case of borrowing. Quite obvious to note that when you lend money, you want a higher return, and when you borrow money, you want a lower return. Therefore, for project B, you'll find that NPV increases as discount rate increases because of the borrowing nature of transaction. That means the traditional way of looking at IRR will not work in this case, and we need to consider the rule in an opposite manner. That is, select those opportunities of borrowing where IRR is less than the opportunity cost of capital. In this case, by the opportunity cost of capital mean the opportunity to borrow from other sources available, for example, financial markets, bank borrowings, etc. Pitfall 2. Multiple rates of return. Consider another project that involves an initial investment of $3 billion and then produces a cash flow of $1 billion per year for the next 9 years. At the end of the project, the company will incur $6.5 billion of cleanup costs. Such cleanup costs at the end of the projects are customary in projects like mining, oil and gas exploration, among others. The projected cash flows are shown here. Let us see the relationship between the project NPV and discount rate for this project as shown here. As we can see, there are two discount rates that make NPV equal to 0. These are 3.5% and 19.5%. As the discount rate rises, NPV initially rises and then declines. So 2 times NPV crosses the 0 NPV line. First on the rising side and then second on the falling side. The reason for this change in direction and therefore the change in NPV sign is that there is a change in cash flow signs. Unlike our previous examples, there is also a change in cash outflow at the end. So we can see as many IRRs as there are changes in sign of cash flows. Particularly so when such outflows, for example investment, decommissioning costs, etc., are substantial expenses. And sometimes there are cases where there won't be any IRRs even. Often, the most simple solution available in such cases is to consider NPVs, that is net present values. Pitfall 3. Mutually exclusive projects. Firms often have to choose from several projects available. Many of these projects are good projects with positive NPVs, but mutually exclusive projects. That is, it is not feasible to take all of them. This may happen for many reasons. Most important of them is capital. Capital is a scarce resource that is available only in limited quantities. Many times here, IRR can be misleading. For example, consider the projects D and D here. Here also, it seems that IRR and NPV rules contradict each other. The IRR rule suggests that project D is more profitable. In contrast, NPV rule suggests that project E is more profitable. In such cases, IRR rule can be salvaged by examining the IRR on incremental cash flows. Let us look at how to do it. Compute the difference between E and D cash flows. Then examine the IRR on the additional $10,000 being spent. That is, the incremental cash flows from undertaking the project D, do they justify the investment? As we can see, the IRR on incremental cash flows is 50%. That is more than the opportunity cost of capital. This is also confirmed by the positive NPV of the project. As we can see, there are many things that can go wrong with IRR. However, IRR is still a very useful benchmark or a decision rule often employed by managers. You would often probably not hear NPVs or dollars in boardroom discussions, but return figures when project profitability is discussed. Thus, IRR figure can convey the profitability of a project in an easier manner. To clarify this argument, have a look at the project cash flows, NPV and IRR estimates for two projects X and Y as shown here in $1,000. It is an interesting example as both of these projects offer the same NPV of $1,400. As rational individuals, I am quite sure that you would select project X against Y. Why? Investing in project X is clearly attractive as it offers you $1,400 by investing only $9,000 as against $9 million in project Y. This also reflects the higher IRR level of X, that is 15.6%, as compared to that of Y, that is 8%. A qualitative argument in favor of project X goes like this. Setting project X is rather easy, less costly, less manpower, maybe less time involvement. Project Y involves a lot of cost and expenses and your managerial resources such as time. If unsuccessful, there would be much heartburn in case of project Y. So it is too obvious to notice that project Y is not probably worth the worry and time compared to project X. In such cases, IRR offers a good advantage in selecting and rejecting the projects. To summarize, in this video, we discussed various pitfalls of IRR. We discussed the problem of lending versus borrowing and how to interpret IRR in these situations. We also examined the scenario where multiple IRRs due to changing sign of cash flows. In such cases, NPV provides more consistent results. We also discussed the case of mutually exclusive projects where IRR can still be employed by using incremental cash flows. Despite all these shortcomings, IRR is still a useful tool while comparing project investments. Capital investments with limited resources. In this video, we'll discuss the project selection criteria when capital is limited. This is often referred to as the problem of capital rationing. Till now, our discussions have rested on the proposition that a firm increases its wealth if it accepts a project with positive NPV. However, there are various constraints and limitations from undertaking all such projects. One of the most important issues in this regard is that capital is a scarce resource. Therefore, firms need to solve the problem of what economists call capital rationing. When the capital is limited, firms need to select those projects that offer the highest NPV, that is, maximum return for each dollar invested. Let us start with a simple problem of capital rationing. Consider the following three projects with cash flows as provided here. All three projects are attractive, but the firm has only $10 million to invest. In that case, it can invest in project A or in projects B and C, but not in all three. Although this is a rather easy case, as we can see the NPV of project A is less than B and C combined. However, things are not always so easy. When the projects are limited, we cannot choose between projects solely on the basis of the net present values. Then we focus on the projects where we get the maximum return for our investment. That is, highest NPV for the given investment. This measure is often called the profitability index and computed as shown here. Profitability index PI equal to NPV upon initial investment. For these projects A, B, C, the PI is computed as shown in the table here. As per the PI criteria, you would first select project B and then C. Therefore, if your budget limit is $10 million, we should accept only the two projects. However, real life examples are not so simple. Let us see a more involved example here. In the previous example, another project C is added, which comprises investment in the next year. Consider the following projects now and this revised scenario. Suppose the firm can raise only $10 million in each of the years t equal to 0 and t equal to 1. Now if you consider projects B and C, you will miss out on D. The other alternative is to consider A at t equal to 0. This provides an additional cash flow of $30 million at t equal to 1. This, along with 10 million additional resources, the firm can also undertake project D next year. Projects A and D combined have lower PI but have a higher NPV. So the ranking logic of PI fails in this particular example, as the resources are constrained in each of these two periods. Or in other words, selection of project D is contingent on the selection of project A. In such cases where additional constraints are present, then the simple ranking method with the help of profitability index falls. Such complex problems are solved with the linear programming techniques, LP techniques. To summarize, in this video, we highlighted the problem of capital as a scarce resource. Thus, even all the positive NPV projects may not be undertaken. In case the problem of capital rationing is limited to a single period, then we can employ the PI or profitability index of projects and rank them. Then one can keep selecting the projects as per the PI based rank till the time the capital is exhausted. However, when there are multiple constraints, then one needs to consider linear programming to solve this kind of capital rationing problem. To summarize, in this lesson, we learned a number of decision rules for making investment. In addition to NPV, other rules are also employed to examine alternate investments. These include book rate of return, payback period, and IRR method. Book rate of return is simply computed as book income divided by book value of investment. Payback method examines the project cash flows against a certain specific cutoff period. Only those projects with a payback period less than cutoff period are considered. Lastly, IRR is the discount rate at which the firm NPV is zero. As per the IRR rule, firm should accept those projects that have an IRR greater than opportunity cost of capital. Like NPV rule, IRR is also based on the DCF technique. There are situations where IRR can give misleading results or contradict the NPV measure. These include lending versus borrowing case, multiple IRR case, mutually exclusive projects, among others. Often, capital is a scarce resource, therefore, all the projects with positive NPVs may not be accepted. This becomes a problem of capital rationing. If capital is rationed only in one period, then the firm can use profitability index method to rank the projects for selection. Then keep selecting the projects till the capital is exhausted. PI computes the NPV of the project per dollar of investment. However, if the capital is rationed in more than one period or there are more constraints, then this method may fail. Then linear programming LP is more general solution.